I want to come back to China in a moment, but I have to say, over the past 12 months when I spoke to senior bankers, as the bad news came out, they consistently said to me, there's worse to come. There's more hidden away in the closet. And yet that's not what the authorities were saying at the time. Why was that?
I think the closer people were to financial markets, and particularly banking markets, the more worried they were. And there have been financial crises before. There will be financial crises again. A defining difference this time was not so much globalisation of finance, very important, but the fact that you couldn't trust balance sheets anymore. You know, the common currency of markets is the ability to assess the trustworthiness of a company or a bank by looking at its balance sheet. You know? It's audited by accountants. There are government agencies which are meant to look over the shoulder of these things. There are rating agencies. However, during the boom in recent years, more and more of the assets that ultimately went bad were not seen on the balance sheets. You know, they were squirreled away, or there was some covenant. For example, if the market value of the parent company dropped below a certain level, then that meant that a loan which was supporting the assets which were off the balance sheet was triggered as being current instead of, could be called on straight away instead of at some time in the future. All those things were far too often hidden from people. And that was part of the loss of trust. I think the banking community was perhaps better aware that the balance sheet information was just not to be trusted. And that is exactly what happened.
There was this underestimation right around the world. For instance, in recent times, we've seen a dramatic slump, a decline in Japan. They were at one stage suggesting they might come out of this unscathed. They're a trading nation. That's the big impact on them. We're a trading nation as well. Are we possibly underestimating the impact here in Australia?
We're continuing to underestimate the short-term impact. The news coming out around the world is very, very bad. The average Australian does not understand how bad. I suspect the average politician doesn't understand how bad this is. Now, some of the data coming out around the world is almost artificially bad, and it won't continue to worsen at quite the same rate that we're seeing at the moment. What people don't get, though, is that the innocent are and will be just as hurt by this as the guilty. Now, it's easy to say, well, the US caused this. You listen to talkback radio, you look at what's on the net, people clearly think the US is the cause of this. No, though certainly regulation in the US could have been better, and the US, like Australia and a bunch of other nations around the world, was consistently spending more than it earned as a nation, raising dangers as a result. Trouble is, however, when US consumers, US businesses, or indeed Australian consumers and Australian businesses pull back because they realise they've been spending too much, it doesn't just hurt those economies. The simple stereotype of recent years is that the Americans spent too much and the Chinese made too much. So America keeps running this enormous current account deficit, China keeps running this enormous current account surplus. But when America and the other big spenders stop spending quite so fast, it's hurting the big exporters. You see it in the stats coming out of China, you see it in the stats coming out of Germany, the world's biggest exporter. And if you look at the stats coming out of the Asian tigers, the pace of fall-off in world trade at the moment is stunning. I have never seen data like that.
I guess it's fair to say that the whole world is really looking to the US to help drive a global economic recovery, but I know that you're reasonably pessimistic about the impact of President Obama's stimulus package. A lot of money, but you don't think it will have the impact that it is really needed.
The task that policymakers face in Australia and around the world is very big. They need to repair banking systems and they need to repair confidence. And both of those things have taken an enormous hit. Now, broadly, not just in the US, but around the world, the right sorts of things are happening. Will this be another Great Depression? No. Why not? Because we've learnt the lessons of the Great Depression. Now, remember that it's not the economic potential of Australia or the world that's fallen over. It's demand, it's spending. Worth noting, economic potential, the number of workers, the skills with which those workers are working or can work, the equipment they're working with, the factories, the mines, the roads, the computers, the rest of it. They are, in Australia and around the world, exactly what they were in late September. It's not a hit to economic potential, the supply side potential of economies. It's a hit to demand. Same thing happened in the Great Depression, but policymakers made all sorts of mistakes. Or to some extent, similar things happened in Japan 2 decades ago when its banking system broke. Now you need, to fix the banking system, you need to pump fresh capital into banks. They can't lend money if they don't have it. All right? So you've got to get fresh capital into banks, and at the moment, for many places, that means nationalisation. Nobody else is willing to put money into these things. Second, you need to get the bad assets off the balance sheets of the banks. Again, if they don't have money, they can't lend it. And even though interest rates have been cut markedly around the world by central banks, it's not having much impact on the actual cost of money to companies and to people. Because the banking system isn't working. So those sorts of things, fresh capital, getting the bad assets off the balance sheets, bringing down official interest rates, that's all happening fast. Worth noting too the other thing that's happening. So look at what Japan did wrong in the wake of its breakdown of 2 decades ago. It took far too long to put the fresh capital into banks and to clear up and move out the bad debts. And as its economy stayed weak, it had the lost decade. It showed up as steadily falling prices. Next year or next week, a car was going to cost less to buy than right now. So people didn't buy, they held off. And that steadily falling prices, deflation is very harmful for economies and held Japan in its lost decade for longer. Now, finally, 10 years after the problems, they addressed the banks, but they also started to print money. Now, ordinarily, economists would call this a terrible thing to do because you print money, it creates inflation. But Japan needed inflation. It took them 10 years to work up the courage, Bank of Japan to work up the courage to do that. It took the US Federal Reserve 10 weeks between the breakdown of the global banking system late September and when they started printing money. I remember Ben Bernanke, chairman of the Federal Reserve, he is an academic. His specialty is the Great Depression. You are now seeing other countries, the likes of the UK, printing money as well. We are, as a world, hitting the panic button. We're also spending a lot of money. You're seeing the stimulus packages, Australia, US, but you're seeing them everywhere. You're seeing them in the UK, you're seeing them throughout the European Union, you're seeing a big one in China, you're seeing ones in Japan. You need to do that. So the consensus amongst economists is that you need, in a downturn, to do things that are timely, temporary, and targeted. You need to do it fast to get out ahead of the recession, because if you don't, the recession gets up ahead of steam, and you just, if the money comes too late, you're just revving up the recovery rather than defending against the downturn. It needs to be temporary, because usually you can leave it to central banks like the Reserve Bank to handle it. And for many nations, they can't afford permanent. And it needs to be targeted, which means it needs to go to people or to companies to get spent, to actually be spent, or governments to spend it themselves off their own bat. You look at the US stimulus package and you ask what proportion of it is each of, because it needs to be all three, timely, temporary and targeted. The stuff that's come out of Congress is somewhere in the range of 12 to 20 cents in the dollar. That's timely, temporary and targeted. The equivalent package that recently passed in Australia is 54 cents in the dollar.